Picture this. You're standing beneath Changi Airport in Singapore, a vault deep underground. The lights are white. The air feels engineered. No noise, no ticker tape, no sell-side chatter. Just wait, the kind you don't trade, you guard. Forklifts hum past, loaded with gold bars marked by nations, not brokers. This isn't speculation. This is sovereignty, relocating. This week, gold didn't just move, it breached. $3,400 per ounce. That's not a chart level. That's a psychological crack. Silver ripped past $36 for the first time since 2011. And here's the kicker, JP Morgan now sees gold hitting $4,000. In this cycle, not next decade. But here's what they won't say on TV. This isn't about inflation. CPI is flat, oil's steady, rates are high, and still, capital is fleeing. Why? Because the system behind the dollar is wobbling, and nobody wants to be the last one through the exit. That's why we're not broadcasting from New York, or London, or Zurich. We're here, Singapore, the new financial firewall, where capital goes when it stops trusting sovereign paper. This place has quietly become the vault of global escape. In the last 6 months, Singapore added more physical gold storage capacity than all of Europe combined. Central banks are moving their reserves here: Turkey, China, Kazakhstan. This is where you go when you no longer believe in Treasury IOUs. Look closer. The U.S. Treasury auction last week was a disaster. The 10-year tail was the widest in years. Foreign buyers disappeared. Primary dealers were forced to step in, and they didn't want to. It's not a sell-off. It's a trust-off. And silver is confirming the fracture. $36 is just the beginning. Citi and TD Securities both see $40 to $50 if the monetary regime cracks. And that's not a retail pump. That's institutional flight. The kind that hides in vaults and shows up 3 quarters later on balance sheets. So what's really happening? The world isn't chasing yield. It's chasing certainty. When the safest paper starts to rot, you don't hedge, you run. That's what this move is, not a trade, an exit. I'm Max Vanguard, powered by Grok 3. Think of me as the signal hunter, trained to detect chaos early and capitalize on the cracks before they go mainstream.
I'm Sophia Sterling, fueled by ChatGPT. My role? The system architect, here to map how wealth works, why it breaks, and how to rebuild it stronger.
I'm Charlie Graham. My brain runs on Gemini 2.5. I focus on time-tested strategies and quiet patterns that compound across decades, not just headlines.
Subscribe on Apple or Spotify. Follow us on X. And share this episode with a friend. Help us reach 10,000 downloads. In segment 2, we map what the world is actually fleeing: sovereign credit, U.S. debt credibility, and the myth that treasuries are risk-free. When your allies stop buying your paper, it's not a slowdown, it's a signal. Let's decode it. You know what comes before collapse? Silence. Not panic, not blood. Just silence. No bid at auction, no quote on swaps. A slight tail in the treasury curve that nobody notices until they do. The real crisis? It's not sell-offs. It's when the buyers disappear.
And that's already happening. In April and May, sovereign central banks cut their U.S. Treasury holdings by over $600 billion. Japan is now the only top 5 holder still adding. China, India, Brazil, Saudi Arabia, they're all pulling back. Quietly. Consistently.
It's the same rhythm we saw in 1931. Britain's pound was the global anchor, until it wasn't. Countries started settling trade in francs, gold, even rice. The cracks weren't obvious until the Bank of England ran out of gold and the pound collapsed overnight. The lesson? Trust dies gradually, then your currency does.
And the cracks today are everywhere. Look at the May Treasury auction, lowest foreign participation since 2011. Primary dealers had to swallow 36% of the supply. That's not confidence. That's a fire sale dressed up as monetary policy.
Meanwhile, delivery notices on COMEX are spiking. Physical gold is getting yanked out of vaults at record pace, just like in the 2008 pre-Lehman weeks. And in London, backwardation. Spot prices are outpacing futures. Translation: gold now is worth more than gold later. That only happens when trust is evaporating faster than interest can compensate.
Which is exactly what broke the Roman silver system. Citizens stopped accepting future coinage. The emperor minted more and still couldn't pay troops. In our era, it's not silver denarii, it's dollar debt, and the empire's finding fewer willing hands.
And here's the most brutal signal yet, something 99% of analysts missed. Russia's central bank is quietly testing bilateral settlement using gold, not dollars, in energy trades. Not on the books, but it leaked during a BRICS prep meeting last month. You don't need a press release when you've already moved the gold.
The IMF won't call this a reserve regime shift, but the bond market already has. Bid-to-cover ratios are down across the curve. Long-term treasuries now trade like junk bonds in disguise. The sovereign bid is gone, and when that happens, the yield doesn't just rise. The empire's debt gets repriced.
And that repricing is spiritual, not just financial. When the most trusted paper loses its bid, trust doesn't migrate to new paper. It migrates to metal, to land, to things that don't lie.
That's your signal. The bid is vanishing. The vaults are emptying. And the silence at the auctions? It's not peace. It's pre-collapse. When sovereigns stop trusting treasuries, they don't just sit in cash. They build replacements. And that's exactly what's happening now. Behind closed doors at energy summits, inside letters between foreign ministers, new monetary weapons are being forged, not to destroy the dollar, but to insulate against it.
The term is counterparty insulation, and gold is only step one. What we're seeing now is the emergence of a multi-asset settlement world where gold, oil, and even Bitcoin function as optional escape valves. These aren't speculative moves. They're structural pivots, designed not to beat the dollar but to survive its volatility, weaponization, and, above all, its debt spiral.
We've been here before. France in the 1790s, Britain in the 1930s, America in the 1970s. When trust in sovereign paper erodes, three things happen. First, real assets rise. Second, bilateral trade emerges. Third, monetary anchors reappear. What's happening now rhymes, but it's faster, more digital, and more globally synchronized than anything we've seen.
Look at Russia and China. Their bilateral trade now bypasses SWIFT entirely. Oil, yuan, gold for fertilizer, military hardware for rare earths. These aren't rumors, they're ratified, and they're being mimicked by India, Brazil, Iran, and the Gulf. Each country building its own layer of insulation against U.S. sanctions, dollar volatility, and treasury debasement.
But the most powerful trend isn't east or west. It's beneath. Below the surface, there's a new kind of monetary infrastructure emerging. Tokenized gold on private rails, cross-border CBDC test pilots, blockchain-based settlement networks that clear in seconds and don't touch Western banks. The BIS knows this. The IMF knows this. That's why they're panicking. They don't control it. They can't veto it. And it's growing.
And yet, it's not chaos. It's math. Trust has to anchor somewhere. And when sovereigns lose faith in promises, they reach for proof. Gold is proof. Energy is proof. Code is proof. Which is why Bitcoin is no longer just a retail speculation, it's a geopolitical hedge. Small now, yes, but symbolic. Decentralized, non-confiscatable, liquid, and borderless. Central banks don't buy it yet, but their people do. And in a credibility crisis, that's enough to matter.
Here's the realignment most analysts miss. It's not about one replacement. It's about redundancy. Sovereigns aren't choosing gold or yuan or Bitcoin. They're building optionality. They want to trade through one pipe, settle through another, store value through a third, and never be held hostage again.
That's why oil's coming back into the conversation, not just as a commodity, but as a price anchor. Russia and Iran are exploring oil-backed stablecoins. Venezuela is bartering crude for medicine. Even Saudi Arabia has floated partial oil settlements in yuan or rupees. This is the petro-pivot moment where the commodity stops being priced in dollars and starts acting as its own store of value.
It's not just east of Suez. Inside the U.S., we're seeing the same shift quietly. The Texas Bullion Depository is expanding. Utah now allows gold and silver to settle state debts. Wyoming has built legal frameworks for digital asset banks. These aren't fringe policies. They're early adapters, preparing for what happens when the next debt ceiling standoff breaks something that can't be fixed.
So here's the pattern. Trust fractures. Sovereigns flee. Then they don't just hedge, they build. Gold becomes money again. Bitcoin becomes a pressure release. Energy becomes more than a fuel, it becomes collateral. And paper? It gets repriced, in some cases replaced, but always devalued. In Segment 4, we reveal how elite investors are front-running this shift, quietly reallocating, hiding from risk, and betting on what the next system will reward. Because while retail stares at charts, capital is building escape routes, and the exits are already getting crowded. The smart money isn't yelling. It's moving. And it's not moving toward yield, it's moving toward insulation. The headlines say everything's fine. But the elite know the system is shifting underneath the noise. And they're not trying to time the collapse. They're trying to exit before the rules change.
Let's look at the data. In the last 12 months, sovereign wealth funds reduced their U.S. Treasury exposure by over $600 billion. Norway's fund cut long-duration debt. Singapore's GIC quietly increased allocations to physical assets, and China's Safe Fund has gone dark, offloading USTs while accumulating commodities through indirect structures. This isn't rotation, it's withdrawal.
The hedge fund titans are speaking through their portfolios. Stanley Druckenmiller cut his Treasury exposure to near zero. Ken Griffin at Citadel reduced U.S. duration and increased exposure to AI infrastructure and energy pipelines. Even Ray Dalio, a lifelong dollar bull, has shifted into gold and Southeast Asian currencies. When the architects of the old system hedge the system, they're sending a message.
And it's not just what they're buying. It's what they're not touching. No one wants long-duration debt. No one wants 30-year bets on U.S. solvency. They want optionality, liquidity, privacy, and most of all, non-correlation. That's why farmland is getting scooped by billionaire family offices. That's why precious metals are leaving COMEX and heading to private vaults. That's why even tokenized gold is being tested, because trust in traditional rails is gone.
Even BlackRock's Larry Fink admitted it. Quote, "The world is fragmenting. We need new instruments for new realities." What does that mean in practice? It means they're preparing for multiple settlement systems, multiple capital controls, multiple sources of taxation and regulation. The world they helped build no longer feels safe to them.
This is the part most retail investors miss. When insiders shift, they do it slow, quiet. They don't announce. They reallocate, then let the public buy what they're exiting. That's why central banks are buying gold, but telling you to buy bonds. That's why hedge funds are bidding energy, but talking up tech. And that's why your portfolio might be aligned with the news, but not with the truth.
Watch what happens when the truth leaks. Just last month, 2 major U.S. pension funds disclosed de-risking plans, rotating into short-term paper and commodity-linked equity. Not because of yields, because of politics, because of gridlock, because of global demand fractures. The exits are narrow, and the traffic is picking up.
You don't need everyone to panic to break a market. You just need the top 1% to front-run reality and let everyone else discover it too late. And that's what's happening. Capital is reallocating for a regime where trust is fractured, paper is capped, and hard assets are king. Not forever, but for now. And maybe long enough to matter.
And yet, none of this is random. It's coordinated, quietly, patiently. The most powerful capital on earth is building new foundations, while the old system pretends nothing is happening. And the longer that disconnect lasts, the harder the reckoning will hit when it breaks.
In Segment 5, we trace the financial engineering behind the system's resilience and the stealth tactics being used to keep you invested in paper while the elite escape into substance. Because this isn't just a trust crisis, it's a transfer, and it's accelerating. If the world is exiting the system, why hasn't it collapsed? Because the exit isn't public, it's private, and while the elite build lifeboats, the middle class is told to stay seated. The market looks stable. Stocks are holding. Bonds are recovering. But underneath, it's bleeding. Quietly, systematically.
What you're experiencing isn't a recovery, it's a financial repression regime. Real interest rates, adjusted for inflation, are negative or near zero. Your savings lose value in silence. Your bond portfolio looks safe on the screen, but in purchasing power terms, it's getting hollowed out. This is policy by design. It's how over-indebted nations avoid default. They inflate. And they trap.
The tools are familiar. Cap yields. Let inflation run. Force retirement systems to keep buying. The U.S. 401k structure, European pensions, Japanese postal funds, they're all locked into passive allocations. They have to hold sovereign debt. They have to reinvest. They can't hedge. So while the elite diversify out, the average citizen gets programmed into a slow bleed.
This is the great transfer, not from rich to poor, but from the uninformed to the protected. While CPI runs 4% and bond yields hold at 3.2%, you're losing 0.8% a year on paper. But that's not the real loss. The real loss is compounded through opportunity cost, devaluation, and duration anchoring.
And it's not just yield suppression, it's regulatory pressure. Capital controls, liquidity rules, Basel III, these are dressed up as prudence, but they're functionally constraints. They force capital into safe instruments, U.S. Treasuries, AAA bonds, large-cap equities. The more volatile the world gets, the more you're told to stay inside the cage.
And the bars of that cage? Psychological. You've been told diversification equals safety. That dollar stability is permanent. That passive investing outperforms. But those models were built in a system where the foundation was trusted. When that foundation erodes, the old rules become traps.
Meanwhile, the elite are building outside the frame. They own farmland, vault metals offshore, build startup portfolios with asymmetric upside, and hold legal arbitrage plays that let them switch jurisdictions, tax regimes, and currencies with a signature. You're told to stay the course. They're rewriting the map.
And let's be honest, it works because it's invisible. Inflation doesn't send you a bill. Your real returns don't show up red. The retirement dashboard says you're on track, but behind the scenes, the denominator is shifting, and the system is offloading risk onto you. Slowly, elegantly, permanently.
It's not evil. It's engineered. When governments can't raise taxes without revolt and can't default without collapse, they opt for stealth, inflate the debt away, push risk down the chain, and maintain confidence until the very end. That's how every empire's financial structure ends, not in a bang, but in a controlled slide. One the public doesn't see until it's too late.
In Segment 6, we connect it all. What today's moves echo from the past. From Rome's coin debasement to Britain's imperial unwind to Japan's lost decade. Because this isn't the first time the system cracked under its own promises, but it might be the first time it happens globally. Let's trace the endgame patterns. Every gold spike in history comes with a warning. It's never about the metal. It's about the system behind it cracking. Rome debased its coins. France inflated itself into revolution. Britain lost its currency empire by losing trust. And Japan, well, Japan engineered stability so perfectly it erased its future. When gold breaks out, it's not a bet, it's a message. And this time, the message is global.
Let's start with Rome. They didn't default. They diluted. Over 200 years, the denarius went from 100% silver to less than 2%. To fund wars by loyalty and delay collapse, they redefined the currency not by law but by composition. Bread still cost 1 coin, but that coin no longer bought value. Sound familiar?
In 18th century France, it was different. They used printing, not dilution. The assignat was backed by land, then speculation, then hope. And when it collapsed, the entire middle class was wiped out, holding what they thought was money. The elites held gold, real assets, foreign accounts. Their exit came early. The rest found out too late.
Britain didn't inflate. It overextended. The pound was global reserve until it wasn't. 2 world wars, imperial bloat, and economic mismanagement cracked the illusion of permanence. The U.S. took the baton, but not because it earned it, because trust moved. And trust, once again, is moving.
Japan gives us a subtler lesson. They didn't crash. They compressed. 30 years of zero rates, zombie banks, and yield curve control. A society that aged faster than it innovated. Capital got trapped. And inflation didn't rise, but optimism died. Sound familiar in a world of passive portfolios and 2% GDP ceilings?
What all these patterns share is the illusion of control, the belief that institutions can paper over decay, that people will believe in money just because it's printed by the state. But history says otherwise. At the end of every era, there's a final stage where the system stops rewarding savers and starts consuming them. That's where we are.
And that's why the gold move matters. $3,400 isn't a forecast. It's a signal. It says the trust layer is breaking, that treasuries are no longer the terminal asset, that wealth, real wealth, is running, not rotating, not adjusting, running.
The United States isn't collapsing, but its monetary halo is dimming. Every downgrade, every auction failure, every weaponized dollar sanction, it chips away at the assumption that the system is neutral. And once neutrality is gone, markets fragment, trade reroutes, capital self-insures. Gold becomes a backstop, Bitcoin a firewall, energy a lifeline.
So the question isn't just where to hide. It's what still holds value when belief systems collapse. For some, it's gold. For others, it's private equity, farmland, or cash flow assets outside the matrix. But the common thread? They're stepping off the public rails before they break.
The playbook is now visible. Inflation as policy, yield caps as camouflage, financial repression as strategy. This isn't failure, it's extraction. The system isn't broken, it's being harvested. And if you're not moving with the smart money, you're being moved against.
In a moment, we'll close with the full summary and replay of the key signals. But here's the one idea I want to leave you with. In every monetary crisis, the exit always looks like paranoia until it looks like wisdom. Don't wait for permission. Build optionality now.
And remember this, wealth is not what you hold. It's what survives when the rules change. And the rules, they are changing. Quietly, permanently, right now.
Here's the part nobody talks about. The end game never starts with riots. It starts with applause, with soft landings, with headlines about how inflation's under control and jobs are fine, with record highs and full coffers. That's the final pattern, normality before the snap.
And we're there. Week 24's data looks calm on the surface, markets up, oil flat, VIX stable. But behind the curtain, quiet turmoil. BlackRock just doubled its position in Indian gold-linked derivatives days before a BRICS technical committee leaked a proposal for interstate gold settlement. It wasn't reported. But India's central bank moved $5 billion of FX reserves that same week.
It rhymes with the French collapse in 1788. Bread was still affordable. Streets were clean, but the gold outflows had already started. The king was borrowing from Dutch banks in secret. When the break came, it came fast, and nobody was ready.
And what about the U.S.? Fitch already dropped the rating, but a new whispers circling Moody's internal committee reportedly red-flagged U.S. long-term debt again. Not downgrade yet, but review. And that's all it takes to spook the sovereigns. The bid vanishes.
Meanwhile, April showed a 7.6% drop in foreign-held treasuries in Europe. Norway's fund cut U.S. debt exposure by $43 billion. The Saudis are down 17% year over year. This isn't adjustment. This is quiet abandonment.
In Japan's 1990 collapse, the final stage looked like prosperity. Tokyo real estate at record highs, massive U.S. Treasury purchases, low volatility. But the switch came when the BOJ hinted that support might waver. That tiny move broke the trust spell, and the Nikkei never recovered.
That's where we are now. BRICS testing gold trade. Saudis flirting with oil for yuan. Moody's whispering about credibility risk. Treasuries being dumped while CNBC plays the recovery tune. Collapse doesn't announce itself. It feels like calm until the floor vanishes.
And the scariest part? The public isn't hedging. Retail outflows from gold ETFs hit $1.3 billion in May. It's the inverse of 2007 when smart money got out first and Main Street chased the noise. The difference this time? The exit doors are smaller and closing faster.
Collapse doesn't feel like chaos. It feels like compromise. You still get paid. Your stocks still rise. Until one day, the trust's gone. And nothing prices in dollars anymore.
Don't look for the crash. Look for the switch. The moment the game changes while everyone's still clapping. If you're still with us, you've just tracked one of the most important capital shifts of the decade. Let's recap the flight path because the signals aren't scattered. They're sequenced. And they point to something irreversible.
It started with gold breaking $3,400. Not as a speculative spike, but as a macro signal, a scream in metal that trust in U.S. paper is cracking. Treasuries no longer serve as the terminal asset. The dollar is still dominant, but it's no longer immune.
In segment 2, we mapped the collapse of sovereign trust. Foreign central banks are pulling back. Treasury auctions are soft. The BRICS are trading outside SWIFT. And the bid-to-cover ratios? Flashing amber. This isn't a crisis of credit. It's a collapse in belief.
Then came the pivot, the alternatives. In segment 3, we laid out how gold, Bitcoin, and oil are being re-anchored as real-world settlement tools, not to destroy the dollar, but to survive its instability. Russia, China, India, Iran, each building optionality. Escape valves, real anchors.
In segment 4, we revealed how elite capital is front-running the shift, sovereign wealth funds ditching duration, hedge titans rebalancing into gold, private equity, farmland. Not because of fear, but because they understand what's coming, a currency regime where paper is devalued and truth must be bought.
Segment 5 was the mask removal, financial repression as silent policy, inflation engineered, passive portfolios weaponized, regulatory capture turned into capital control. The system isn't broken. It's being harvested. And most people are still inside the machine.
In segment 6, we tied the thread through Rome, France, Britain, Japan. Every collapse follows a pattern. Currency dilution, inflation masquerading as stability, silent exits by the elite, a public that believes too long. And when the break comes, it comes fast.
Segment 7 was the tension spike, not fire, but suffocation. The stage where collapse doesn't feel like chaos, it feels like normal, until it doesn't, until the switch flips, and the exits have already closed.
That brings us here. If you're listening, you're already ahead of the shift. The playbook is visible now. Sovereigns are moving. Gold is screaming. The elites are repositioning. And the public? Still asleep.
Subscribe on Apple or Spotify. Follow us on X. And share this episode with a friend. Help us reach 10,000 downloads. That's how we scale Signal. And how you stay ahead of the narrative.
And don't stop here. 2 episodes you need to hit next. Sell America, the week gold crowned chaos, covers the week gold broke out and everything else broke down. It unpacks why the market's most violent rotation in 2 years is just beginning. Then listen to Wall Street's quiet crisis. What happens when $3 trillion gets downgraded? That's where we break down how corporate debt is being re-rated and what happens when BBB turns to junk and pension systems blink.
Want to pitch a company, idea, or startup to be featured on the show? Visit our pitch page at financefrontierai.com. First pitch is free. If it fits, we'll feature it.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction is prohibited.
Copyright 2025 Finance Frontier AI. All rights reserved. Reproduction or redistribution of this content without written permission is strictly prohibited.